This is for the subject capital markets, and the topic of this specific video is the concept of return. Okay, so you have here an article from investopedia.com. By definition, a return, also known as financial return in its simplest terms, is the money made or lost on an investment over some period of time. Okay, so again, return could mean profit or loss. A return can be expressed nominally as the change in dollar value of an investment over time. A return can also be expressed as a percentage derived from the ratio of profit to investment. Returns can also be presented as net results, after fees, taxes, and inflation, or gross returns that do not account for anything but the price change. Okay, sometimes it would include the 401k investment that's in the US, but the equivalent here in the Philippines is the retirement. Okay, but essentially we don't have investments in the form of retirement unless it's provided by the company. Okay. Key takeaways: a return is the change in price of an asset, investment, or project over time, which may be represented in terms of price change or percentage change. A positive return represents a profit, while a negative return marks a loss. Returns are often annualized, yearly returns or yearly losses, for comparison purposes, while a holding period return calculates the gain or loss during the entire period an investment was held. Okay, you can hold investments for as short as possible. Let's say 90 days, 30 days, 180 days, or 1 year, or it could also be as long as you want it to be: 2 years, 5 years, 10 years, or century bonds. The real return accounts for the effects of inflation and other external factors, while the nominal return is only interested in price change. Okay? Total return for stocks includes price change as well as dividend and interest payments. Several return ratios exist only for fundamental analysis, to be used for fundamental analysis. Understanding a return. So prudent investors, more conservative types, know that a precise definition of return is situational and dependent on the financial data input to measure it. An omnibus term like profit could mean gross, operating, net, before tax, or after tax. An omnibus term like investment could mean selected, average, or total assets. Okay, I'm gonna pause for a bit again because of the dogs. Wait, what? Alright, I don't know what happened after the pause. Anyway, where are we? A holding period return is an investment's return over time. It is owned by a particular investor. Holding period return may be expressed nominally or as a percentage. Okay, when expressed as a percentage, the term often used is rate of return, ROR. Okay. So again, normally returns are expressed in terms of years, but there are times that you don't actually hold a certain investment for a year or for a full year. Sometimes it could be, divided into 2 years. You start, for example, September 2020, you hold it until August 2021. So it's a full year, but it transcends 2 years, right? So I have that holding period return, and then you have your annual return, right? The return earned during the periodic interval of a month is a monthly return, and of a year is an annual return. People are interested in the annual return of investment, or year-on-year return, which calculates the price change from today to that of the same date 1 year ago. So you can see whether it increased, did it grow, or did it decrease, why, for what reason. So we'd be interested to have those questions answered. Okay, you're going to probably do your own research, but for the most part, if you're again doing trade in online platforms by financial institutions, especially banks, then normally they provide analysis reports for particular companies. Okay. Returns over specific intervals of different lengths can only be compared when they have been converted to same length intervals, of course, for consistency, comparability. It is customary to compare returns earned during year-long intervals. The process of converting shorter or longer return intervals to annual returns is called annualization. Okay. And then we have the different types of return. Again, the nominal return, net profit or loss of an investment expressed in nominal terms, just the difference in the price. For example, you or you bought an investment for 100 pesos at the beginning of the year, and then at the end of the year, the price or the value of it became 120 pesos. Okay, so there's a 20 pesos increase per share, okay, for one whole year. So that's the nominal return, okay. It can be calculated by figuring the change in the value of the investment, that was our example, over the stated time periods plus any distributions minus any outlay. So in our example, beginning of the year, end of the year, so that's 1 year. Distributions received by an investor depend on the type of investment or venture, but may include dividends, interest, rents, rights, benefits, or other cash flows received by an investor. So in the case of stocks, so for example, you have that 100 pesos is the market price at the beginning of the year. You bought it for 100 pesos per share. Excuse me. And then at the end of the year, the market price is 120 pesos per year. So there's an increase of 20 pesos. But during the year, let's say you also receive a dividend of 5 pesos per share. Okay, so aside from the increase in the market price of 20 pesos, you also have the return, a dividend return on investment at 5 pesos. So essentially, the total return that you receive for that 1 year is 25 pesos. So that is your nominal return. Okay. Outlays paid by investor depend on the type of investment or ventures, but may include taxes, costs, fees, or expenditures paid by an investor to acquire, maintain, and sell an investment. So for example, in the dividends that you've received, I think dividends are, how much is the tax for dividends? 10%, I think. Okay, so instead of 5 pesos, what you actually receive is 4 pesos and 50 cents, because 50 pesos is the withheld tax for the taxes. Okay, for the dividend, alright? And then, so, in that sense, the nominal return is 25 pesos, but if there are outlays, you have to deduct that, of course, so it's only 24 pesos and 50 cents, okay? A positive return is the profit or money made on an investment or venture. Likewise, negative return represents loss or money lost on an investment or venture. For example, assume an investor buys $1,000 worth of publicly traded stock, receives no distributions, pays no outlays, and sells the stock 2 years later for $1,200. The nominal rate of return, the nominal return is in dollars is 1,200 minus 1,000, the selling price minus the cost of buying it, so $200. But this is for 2 years. Okay, so if you're going to compute for the annual return, so divide $200 by 2 years, so it's $100 per year. Okay, or annual. Real return. The real rate of return is adjusted to changes in prices due to inflation or other external factors. So this method expresses the nominal rate of return in real terms, which keeps the purchasing power of a given level of capital constant over time. So let's say, from 100 pesos to 120, so that's essentially 20%, right? But let's say during the year there is an inflation rate of 4%. Okay, so your real return is not actually 20%, but only around 16% because there is inflation at around 4%, right? So adjusting the nominal return to compensate for factors such as inflation allows you to determine how much of your nominal return is real return. So for example, you have your government bonds, right? And the average return on that is around 4%, okay, every year. So if the inflation is also around 4%, and then the return on the government bonds is 4%, did you actually profit on that or not? Okay, because the inflation and the return is almost the same. So there is that. Knowing the real rate of return on an investment is very important before investing your money. That's because inflation can reduce the value as time goes on, just as taxes also chip away at it. So the total return for a stock includes both capital gains or losses and dividend income, while the nominal return for a stock only depicts its price change. Okay? Investors should also consider whether the risk involved with certain investment is something they can tolerate given the real rate of return. Expressing rates of return in real values rather than nominal, particularly during periods of high inflation, offers a clearer picture of an investment's value. Then we have return ratios, subset of financial ratios that measure how effectively an investment is being managed. They help to evaluate if the highest possible return is being generated on an investment. In general, return ratios compare the tools available to generate profit, such as investment in assets or equity, to net income. Return ratios make this comparison by dividing selected or total assets or equity into net income. There would be examples later, don't worry. The result is a percentage of return per dollar invested that can be used to evaluate the strength of the investment by comparing it to benchmarks, like the return ratios of similar investments, companies, industries, or markets. So examples, we have return of capital. What it means is the recovery of the original investment. Okay, but other than that, we have these three. Return on investment. So a percentage return is a return expressed as a percentage. It is known as the return on investment, ROI. Return per dollar invested. ROI is calculated by dividing the dollar return by the initial dollar investment. So in our example kanina, 20 pesos over 100 pesos. So that's 20%, right? This ratio is multiplied by 100 to get a percentage, so 20%. So there have an example here, assuming a $200 return on a 1,000 investment. The percentage return or ROI is 200 over 1,000 times 100 is 20%, right? So essentially, it's the amount of earnings against the principal or the amount of money that you invested. Return on equity, profitability ratio calculated as net income divided by the average shareholder's equity that measures how much net income is generated per dollar of stock investment. So normally this is used by companies, corporations that have shares as a form of ownership, okay, for their stockholders. So example, if a company makes $10,000 in net income for the year, and the average equity capital of the company over the same period is 100,000, the ROE, return on equity, is 10%. Okay, so how much funding did they use in their operations as against the amount of earnings that they have for that particular year? Okay, so it's the amount of earnings, net income, over the amount of funds that they have, equity only. Okay, excluding the debts or borrowings, just the equity. Funds from technically owners, okay, of the business. Return on equity. And then we have return on assets, profitability ratio calculated as net income divided by average total assets. That measures how much net profit is generated for each dollar invested in assets. So essentially, it's asking, how well did the company utilize the assets that it has? Okay, how much earnings has been generated by every dollar of asset that they have. Okay, it determines financial leverage and whether enough is earned from asset use to cover the cost of capital. Net income divided by the average total assets equals ROA, return on assets. Return is normally, in the formula, you have your net income as the denominator. It refers to the return, right? And then your denominator, it would depend. If it's return on assets, so you have average assets as denominator, If it's return on equity, so you have your average shareholders' equity as denominator. If it's return on investment, so the amount of investment would be the denominator. Okay. Net example, net income is 10,000, average total assets is 100,000, so ROA is 10,000 over 100,000, 10% then. Okay. So those are just examples. Alright. So that's it for this one. We have the concept of return. Thank you and God bless.